Markets are navigating a complex mix of pressures right now, from higher energy prices to shifting Fed policy and growing questions about the strength of the U.S. economy. At the same time, investors are weighing whether this is a recession signal, a slowdown, or simply a transition to a different phase of growth. We're going to break it all down with my guest, Brian Levitt of Invesco, in just a moment on this episode of UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Very excited to have Brian here in the studio with me. Brian, great to see you.
Always good to be here, Anthony.
Yeah.
Thank you.
As a bit of a mid-year kind of outlook, you came here at the perfect time. We're just after our Memorial weekend. The summer has begun, even though the weather may not feel like it here in New York City. But I wanted to ask you, there's a lot, obviously, that the first 6 months of the year have brought us. In the beginning of the year, it was concerns about software because of AI development. Then it moved into the Iran conflict that's still ongoing. We've seen the impact of oil prices on inflation. So where do you see us now, given what we've seen over the first 6 months of the year, economically, market-wise?
2 years in a row, I was very excited about what I would consider to be as good of a backdrop as you could have for markets coming into a year. 2 years in a row, it got disrupted momentarily by a policy decision. Obviously, 2025, the tariffs this year, the war in Iran. In both instances, there were some adjustments with regards to market leadership and rates and inflation expectations. But in both instances, the resilience of the economy came through, and corporate America continued to deliver earning results that were beyond impressive.
Yeah.
So it's a market that has pressed higher. You've seen a little bit of a shift in leadership from the small cap value to more of the mega cap again. And that's consistent with this idea of a slowdown in activity, a repricing of Fed expectations because of the disruption we've had around the war.
Yeah, we have this interesting chart that you sent us that I would love to call up about. It's looking at median S&P 500 index levels and its relationship to Brent crude, because I think for a lot of our viewers, the price of oil is a real factor right now. It's almost double what it was just a few months ago. And certainly we've seen inflation peak, hopefully temporarily, but because of those prices. Can you talk us through that chart? Because I find it to be really interesting.
Yeah, we show it to people because anytime there's a spike in something, it happens really quickly. And so investors who weren't there try to get there. And what the news media tends to do is they tell you why this problem that just happened is going to get a lot worse. They never really think about what could get better. And so what ends up happening is investors, by the time they tend to pile into things like oil or natural gas after a shock, they tend to underperform over the subsequent months. And perhaps paradoxically to people, the equity markets tend to do well after these shocks 6 and 12 months later. And the reality is, if you go back and look at most conflicts, the market tends to absorb it quickly and then tends to perform quite well in the 12 months following the peak in geopolitical risk.
Right. So hopefully, past is prologue, right? And we can sort of see maybe down the road there are some positives. But although you did bring up a really good point, earnings have been really strong, corporate profits are high, fundamentals are there. But, and even looking at things like the bond market, if you look at the 10-year, right now as we sit here, the 10-year has come off, the yield itself has come off its recent peak, which was about an 18-month high itself. So now it's sitting around a 448, 450. But credit spreads are incredibly tight and have been, which is an indicator that investors feel confident in the state of the economy. Can you say the same thing? When you look at credit spreads, what are you seeing there?
It's stunning.
Yeah.
And
they've been tight for a long time.
Tight for a long time, and they've tightened since the war began.
Right.
And if that isn't a testament to the fundamental strength of corporate America and the resilience of the U.S. economy, I'm not sure what is, right? Credit spreads are a very true canary in a coal mine for markets. I know investors get concerned when they're tight, but they can remain tight for a long time. You have to ask yourself what would cause credit spreads to blow out. Usually it's a significant deterioration in economic activity and a change in what the Federal Reserve is going to do. So what's just happened, credit markets have looked at both of those and essentially yawned. They've said, yeah, the U.S. economy is going to slow, but there's enough support from the government, from investment, the highest income consumers are doing well. The world backed out 3 rate cuts from the Fed, now maybe is contemplating a rate hike. I don't suspect they will. And the credit market yawned. They did not care.
They barely paid it. It seems like they barely paid attention to the news, right?
And it's, so you can look at it one of two ways. Some may look at it and say this market is way too complacent.
Yeah.
I look at it and say this is fundamental strength in corporate America and resilience of the U.S. economy.
Do you think it's sort of like there's a lot of headlines out there every single day, and a lot of it is related to what's going on in Iran, and it's like, will there be a ceasefire? There's another attack. And it's almost as if, I always use the word complacent as well when it comes to markets, but clearly it's the real fundamentals are there. But it seems like there's just so much headline news every single day that it's hard to even decipher through the noise. So you just kind of look again at the basic fundamentals of the markets.
Yeah, I look at what the markets are telling me. So I'll tell you when I start to get concerned, it would be things like inflation expectations rocketing higher.
Yeah.
They've risen, but they're pretty stable here. 5-year break-evens around 2.5, 260. I'm okay with that.
Okay.
I'd be worried if the dollar was strengthening meaningfully. It's up a bit, but it's not going nuts. I'd be nervous if credit spreads were blowing out. They're not. So the market is telling me that this is going to be okay. Now, what I think investors get wrong is I always want to assess markets not good versus bad. If you're assessing the world as good versus bad, you're probably never going to invest because things are rarely good. Anthony, I'll tell you, almost every time I've been introduced in my entire life to speak, whoever's introducing me says, well, Brian has a lot to talk about today, right? So there's always a lot going on.
Yeah.
Markets,
by the way, I thought the same thing when you walked in today. I was like, Brian's going to have a lot to talk about today.
Markets trade on whether things are getting better or worse relative to expectations. So think about the beginning of the war on February 28th. The market assessed this as, wow, this is worse relative to expectations. And you go down pretty quickly, right? 8-10% on the broad indices. From there, if you get a ceasefire, are things going to get better relative to expectations, or are they going to get worse? And in reality, at least from the hot perspective of the war and the fact that the two countries are speaking, things are getting better relative to expectations. Could that turn? Sure, but it doesn't seem like it's in America's best interest at the current moment, or at least the administration's best interest with the midterms coming up.
Yeah, well, I'm going to get to that in a moment with you, but I do want to kind of pivot to the Fed for a second, because you did say that the market is pricing in hikes, even though here, I'll tell you what our chief investment officer's view is: 25 basis points before the end of this year cut, and another 25 likely in spring of 2027. That seems to be our base case, and we've pushed it out a little further than we expected. It was 2 this year, now it's 1 and 1.
Yeah.
What are you thinking about the Fed? We've got Warsh now coming in. Powell still sitting there with the board. What are your thoughts on what the Fed needs to do, or what they will they do?
Ultimately, I think the neutral rate is 3%.
Okay.
And so I've thought that's 2 years in a row. I thought we were going to 3%. 2 years in a row policy prevented us from getting there. Why do I say 3%? In reality, the spread between the funds rate and the 10-year Treasury should be around 4.25%, 4.5%. If you're less than that, you're restrictive. So you have a Federal Reserve that's restrictive right now while the job market is slowing. Now, can the Fed do that much about the job market? No. But they could try, and it's in their mandate to try. Now, the only way they wouldn't do that is if inflation expectations are getting out of whack. And so what you've seen is 1 year, 2 year, 3 year break evens. The bond market's expectation for inflation climb meaningfully. So that starts to get a little bit worrisome. But when you look out at 5 year, the market's kind of sitting there saying price stability, and even the 3 year has come in more recently. So if the Fed has price stability, even with us all paying $70, $80 to fill up our gas tanks, if the Fed has price stability, they'll likely lower rates. First thing I learned in this industry is don't fight the Fed from an asset portfolio perspective.
Right. Yeah, and obviously we're looking at the yield curve every single day. I know you're doing the same thing, and as we said, the long end, it's higher than the front end, but it's coming down a little bit.
Yeah.
And I mean, what does that indicate to you? I mean, obviously, Warsh and the Fed are always looking at what's happening in the Treasury markets, but they're looking at inflation, they're looking at jobs. We did see the ADP number come in recently, a little bit lower than the previous month. Not sure if that's an indication of a slowing market or job market, because right now it seems like the job market is still pretty stable.
It's okay. Yeah. I mean, we're not firing people, but
Right.
we're not hiring a ton of people. Unemployment
Kind
rate
of
remains
neutral
historically
ground.
low. Yeah. Well, what's the bond market telling us has been interesting. The move higher in the bond market, some of it's been inflation expectations this year, but perhaps not as much as people believe. Some of it's just been recalibrating where the Fed is going to go and where the terminal or neutral rate may be. So ultimately, I think rates are coming back down. This move in rates is being driven more from the Strait of Hormuz, what's happening with oil and gas prices, what that means for longer-term inflation, what that means for the Federal Reserve. Ultimately, I think we get some resolution on this. The good news is we don't have a resolution as of this current moment. And again, the markets have shrugged it off. Admittedly, leadership in the equity market has changed, but you're still pressing highs in the major indices.
Yeah, still a lot of AI momentum there, especially in the big tech names.
Correct.
I just even saw the Russell 2000, which is the small mid-cap index. I mean, it hit an all-time high.
Yeah.
So there's some good things happening on the market side. So as an investor, if you're long, if you're long the markets right now, you're doing pretty well. So that was the question I was going to ask you as we wrap up here. With midterms on the horizon, we got the midterm elections in November, so there's a little bit of policy uncertainty. Obviously, there's still no, end in sight yet for the Iran conflict, although we hope it resolves itself soon. Where are you recommending investors put their money to work? It's considering, valuations are, they're not over the top, but they're kind of getting up there.
Yeah.
Where's the best place to put money right now?
Yeah, I'm not thinking significantly about the midterms with regards to where I want to allocate money. I mean,
Right.
these happen every couple of years. We kind of know how they go. One side gets single party rule, then they get kicked out, then the other side gets single party rule. So we flip back and forth. We're going to have a divided government. Investors have been told that that's fine. I don't know how statistically significant
Right.
that is, but they've been told that that's fine.
And that's our base case here at CIO as well. Divided government.
Divided
after
government.
this
At least
midterm.
the House to the Democrats.
That's right.
We'll see about the Senate. But the markets have done well under most combinations. In fact, they've done well under really each of the combinations that are possible. So I'm not overly concerned about that. What I focus on with market leadership is the direction of the economy and what the policymakers are going to do. And so it was very clear the direction of the economy was expanding coming into the year. You had a lot of fiscal support in a
Yes.
lot of places and a Fed that wanted to lower rates. I remember telling people at the beginning of the year, if you're not bullish now, I don't know what to tell you.
Yeah.
Right? You had all of this policy support. So now you're slowing down a bit. When you're slowing down a bit, that's when you go back to mega cap growth, higher quality. That's when government bonds rally. So my expectation is government bonds will rally here, and they've started to.
Yeah.
The big question for investors is, can we get back on that expansion path? Can we get a reasonable resolution with Iran that brings any type of inflation pressure off the boil, even though my expectations are contained, inflation expectations are contained,
Okay, good to
and
hear.
brings forward rate easing again.
Right.
If you get back to that, leadership should shift again to non-US dollar, smaller capitalization stocks.
Excellent. Brian, I wish I had more time. Always great to sit with
Great to
you.
see you as
Brian
well.
always has a lot to say. Always stuff going on for you to talk about.
Always.
Appreciate you making time
My
to
pleasure,
sit
Anthony.
here
Thank
with us.
you.
Brian Levitt from Invesco. Thank you, my
Thank
friend.
you.
And thank you all for joining us. Lots more information coming out of our Chief Investment Office and our great partners like Invesco. You can check everything out on our Insights website at ubs.com/views. Plus, UBS is on social media. You can follow us on LinkedIn and Facebook. Plus, the studio has its own dedicated Instagram channel. Follow us at UBS Trending. And as always, if you have any questions or want to continue this conversation, please do so with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody. Thank you.